Hello, everybody, and thank you so much for joining us today. My name is Jonah with Discover, and today we are going to be talking to Steve Clapham. But before we dive into anything, let's just make sure our video and audio is working well. So if you can hop in the comments, let us know that you can see and hear us all right. Steve, how are you doing today?
I'm doing well, Jonah. I'm sitting in a sort of cold, dark London evening. It's that time of year, the fall, where the mornings are beautiful and fantastic, but our clocks have just changed and it's
Yep.
quite dark.
Yep. I'm actually in Paris right now, so I'm not too far away. I'm
All
experiencing,
right. Oh, well,
yeah.
we could have
And
met
I
for a
didn't,
drink.
yeah, there, I didn't even know about the time change either until like someone told me. So all of a sudden the day just got shorter, and it's dreary, but it's a good time to dive in and learn some stuff and educate and get ready for next year's sunshine, right? But before we go any further, for everyone watching, I just want to set some expectations. Feel free to hop in the chat at any point. Let us know if you have any questions. Let us know where you heard about Steve or where you heard about Discover. And feel free to use that place as a discussion. We will try and get to all of your questions during the presentation. And if not, we will have time after the presentation to do an actual Q&A where we can answer those questions. So if we don't get to them before, pop them in at the end, and we will try and answer all of your questions. Also, if Steve is moving fast or you have to get up away from the computer for a second or anything around you happens, don't fret. All of this will be available in a replay. It'll be emailed to you if you RSVP to the event. It'll also be on the YouTube channel here and on the Discover page itself. So just to properly introduce this event today, we are going to be talking to Steve Clapham about unlocking your investing superpower and company valuation. Topics we're going to cover today is we're going to break down the methodologies which professional investors use to value businesses. Little background on Steve. Steve is the founder of Behind the Balance Sheet. Following a 25-year career as an investment analyst, Steve decided to put that experience to good use and train the next generation, or sometimes the current generation, of investment analysts, private investors, and portfolio managers. Steve's experience includes working on the sell side for a number of investment banks and the buy side as a partner at not one, but two multi-billion-dollar firms. He has won awards like the prestigious Starmine Most Accurate Forecaster Award and is still regarded as one of the top forensic analysts around. Steve, I know you got a great presentation today, and I don't want to take up any more time, so I'm going to hand it over to you.
Well, thanks, Jonah. I really am excited to tell you folks about valuation, and Jonah's done a good job of talking about me. I mean, what I do now is I have three main lines of business. I do bespoke research for a bunch of institutional clients. I do training for those clients. Those clients include some of the largest, most successful institutions in the world. You know, people like Fidelity, Wellington, Schroders, Bailey Gifford. And I've got an online training school. And what I want you to go away with is the idea that I know what I'm talking about. I've been doing this for forever. And I wrote a book, The Smart Money Method, which came out a year ago. Don't buy it now, because on the anniversary, the 24th of this month, the anniversary of the book launch, we're going to do a special offer on Amazon on Kindle. So watch out for that. As I said, we've got an online training school, and you know, it's been very popular. This is what a young man, an equity analyst at a wealth management firm, who's now graduated up and he's now become a junior partner at one of the big London hedge funds. And he said, you know, I really enjoyed it. I found it very valuable. And I'm here because I hope that you're going to be interested in buying one of my courses, but I'm here to educate and I'm here to help you. And I've got a bunch of free resources, a YouTube channel. If you go to youtube.com/behind the balance sheet, you'll find a whole gamut of interesting, helpful, useful videos with investing tips, accounting red flags, and so on. You'll find that enjoyable. If you go to my website, behindthebalancesheet.com, and you sign up, then you'll be able to get our free newsletter, and also you'll be in our, we call it the club site, where we've got, we post interesting articles, we've got fund letters, and we've got some free training material, and we've got a fantastic library, including hundreds and hundreds of fund letters. And lastly, I've got a podcast. I've just launched it. I do it once a month, but I've had the first 3 podcasts. I've had 3 of the top hedge fund managers in London. John Armitage manages $28 billion. Stuart Roden's actually retired, but I mean, genius guy, brilliant content. Also, Pete Davis, who's the senior partner of Lansdowne Partners, one of the top hedge funds in London. So do have a look at all of that. If you want to get hold of me, I'm on Twitter at Steve Clapham. You can find me on the website, behindthebalancesheet.com. And if you want to email me, info@behindthebalancesheet.com. And I'm going to be giving you some extracts and talk a little bit about my valuation course, which you're going to hear is heavily discounted at 30% off for the purpose of this webinar. So let me just explain a little bit about the course and give you some useful tips that you can take away and utilize in your investing. So the course it's actually in 5 or 6 modules, but basically we've got 4 parts to it. We've got the introduction about the theory, we've got building an enterprise value, we've got a whole thing on stock market multiples, and then we've got a very long series of some simple, some more complicated techniques that you can use to value businesses and find stocks that are going to make you money. So let me just get into this. At the end of the course, I say you'll be able to understand and implement all the main intrinsic valuation techniques and the relative value techniques, which I'm going to explain. You'll understand how company fundamentals drive valuation. You'll take away some practical frameworks for valuation. And this is very, very important, because a lot of valuation content is very theoretical. And as I'll explain to you, the theory is a waste of time. And after doing the course, you'll not only be familiar with all the multiples, but you'll be able to calculate a rolling enterprise value, and you'll be able to value a company. And that is the key, most important thing. So let me just explain a little bit about why this is important, what you do in the course, and give you some tips. So this is what's in the course, the introduction and theory. I'm going to tell you about these golden rules. I'm not going to talk about the WACC and the CAPM, the capital asset pricing model. I'm going to tell you a little bit about how you build an enterprise value and how you build that up. And I'm going to talk a little bit about multiples, about the PE multiple and other EV-based multiples. And I'll touch on a few of the other techniques that we talk about in the course. And in the course, we've got lots and lots of case studies. And we've got this little exercise to help you understand valuation. It's called Guess the Stock. So we give you the financial parameters, and you have to guess what the stock is, what it's worth. That's really good fun and really helps you streamline, tune up your valuation. So let's get started on the stuff that can help you. Now, there are lots of very sophisticated valuation theories. If you go on YouTube, you'll find them, there are 100 of them. But they're all basically predicated in one of 2 themes. You've got DCF-driven valuation, and you've got valuations involving beta. Now, my view is that investment is a very practical, simple exercise that you should not have any Greek letters. And anything that involves a Greek letter means it's of very little practical help to investors. There are lots of good free resources in this subject if you're interested in valuation theory. Aswath Damodaran's done lots and lots of great material. Have a look at his stuff. But there are 2 main approaches to equity valuation. One approach is intrinsic and one approach is relative. And you'll see that I talk about equity and the firm. And I'll explain more about that later. But what I'm going to concentrate on in this session is the relative valuation methods. But before we get there, let's talk about some golden rules of valuation. Golden rule number 1, valuation looks scientific, but it's really quite subjective and prone to bias. The easy question is this a good company? The much harder question is this a good investment? And you'll hear a lot of sell-side analysts talking about this stock has been trading on a multiple of 15 to 17 times. Our valuation is 16 times. Our forecast is 353. And therefore, we're going to have a target price of, got to think what that is, 353 times 16 is about 56. But the problem is that valuations can and do change, right? And you've got to remember that looking back is like driving, looking in the rearview mirror. You've got to look through the windscreen. You've got to look forward when you're thinking about valuation. Golden rule number 2 is the value of business lies within a range of probability. It's a very uncertain world. So why should we expect accurate valuations? That analyst that's doing that 16 times 353 calculation is giving you a very precise estimate, but that doesn't mean to say it's accurate. And people confuse accuracy and precision. They are not the same thing. And that's why I say always use valuation ranges. So when I was a professional analyst recommending to my bosses that we should buy or sell a particular stock, I would always say, look, I think this company is going to make $3.50 to $4 of earnings, and it should be on 20 to 22 times. So we've got a range of 70 to 90. And if things go wrong, the chances are it'll be on 50 to 60, or it could be a 0. And using valuation ranges means that you have an understanding that there's not a single answer. Using valuation ranges is a great discipline, because then when it gets into the lower end of that valuation range, you need to be thinking, okay, at what point is this stock going to be fair value? And maybe I should be thinking about replacing it with another stock in my portfolio. So valuation ranges are golden rule number 2. Golden rule number 3 is about financial models. Now, I'm a great believer that less is more in financial modeling. Spreadsheets, of course, can be fantastic. I mean, super effective. They're a fantastic tool, but they are highly error prone. A friend of mine runs an investor relations strategic consultancy, and he has looked after one of the oil majors for the last 20 years. And one year they decided that what they would do is they would check how the analysts derived their forecasts. So they called up the top 3 analysts, number 1, number 2, number 3, as rated in the II and other surveys. And they asked them to send them in their models. And they then sent the models to the accounts department. Every single one of those models, I'm not kidding, every single one had an error in it. At least one, multiple errors. Simple models are the most effective. I will always do a back of the cigarette packet calculation to make sure that I'm in the right ballpark. So I just using a rule of thumb. Now, as I said, I'm not a great believer in investment theory. It's fine for academics. And if you go to university, you go to school, you study finance, you will get rammed down your throat more Greek letters than you'll find in the Greek alphabet, I suspect. Our courses explain the central theory, which is the capital asset pricing model. The capital asset pricing model is a complete waste of time and energy for anybody that's set out to make money in the stock market. I explain why you should ignore this theory. Discounted cash flow is the only correct theoretical way to value a business. But forecasting cash flows is extraordinarily difficult, even if you're inside the business. For an outsider, for somebody looking in that doesn't have all the detailed information, it's almost impossible. But you'll see time and time again, people do these 10-year DCF models. I'm not sure why. There are some other intrinsic tools which are quite powerful, but they're harder to use. And so the best, the most reliable, and the most popular method is to use relative valuation. And if you remember, we went back to this chart. What I showed you was these relative valuations. These are multiples. And they can be multiples of equity, or they can be multiples to the firm. So equity is where you're just looking at the shares. Firm is where you're looking at the total valuation, including the debt. So when should you use DCF and when should you not? Well, long-term loss makers, biotech stocks. I used to follow Eurotunnel. Eurotunnel in its initial stages, the only way you could value it was to use a DCF. The second time that I use DCF is to do sensitivity analyses. If I'm trying to figure out how sensitive the valuation is to a change in an external environment or a change in a factor, I will sometimes use a DCF because I'm using the same incorrect data to assess the sensitivity. So the sensitivity may not be 100% accurate, but because I'm using the same basis, it should give me a pretty good feel. And the other reason is to use a DCF is if you're trying to understand how much of the value lies in the next few years and how much lies beyond that. Because once you start buying stocks whose value all lies way out in the future, you've got an inherently much riskier investment. And I think because interest rates are so low, many stocks today are on very high multiples, and they're on very high multiples because it's predicated on some massive growth assumption where the company is going to be super successful in 2035. Well, that's inherently highly risky. And I think a lot of these stocks are going to surprise people, and they're not going to surprise people on the upside. And the other reason is to value a bond or a bond-like payment stream where you've got some type of infrastructure asset. But the DCF is of very limited use in daily equity valuations. So our preference at behind the balance sheet is we like to use a combination of measures. Now, it depends on the industry, but we always use EV to sales, and we have done for decades now. EV to sales has become much more fashionable recently because interest rates are so low, because many of these loss-making companies coming to the stock market, it's very difficult to value a loss-making company except on the basis of its turnover. So EV to sales has come into vogue, but it can be equally useful if you're looking at a traditional business. And it's particularly useful if you're looking at a cyclical company. Now, I know we haven't had much of a cycle. We had a massive depression with COVID. We had a massive depression with the global financial crisis. And we haven't had a more normal economic cycle for quite some time. But that's not to say we won't. And EV to sales is a very useful tool if you've got any sort of cyclicality in the business. And many businesses have a cycle, even though there's not an economic cycle, there's a capacity demand cycle. And EV to sales is very useful for industries where there's an imbalance between supply and demand. P, I'll talk more about that in a little while. I like to use EV EBITDA and EV to EBIT. I like to use the free cash flow yield. And I'd make extensive use of EV-based measures. And in order to do that, it's necessary to know how to calculate the EV. And these are some of the multiples using equity, using the market cap. And here's some multiples using enterprise value. And we make the distinction between these. And we always like to use at least one from each bucket, because at the end of the day, we are valuing the equity, but we want to make sure that we're taking the total value of the business into account. Why do we want to do that? Why is enterprise value important? Well, the PE is the most popular valuation parameter and it's the cleanest, but it doesn't factor in different capital and tax structures. And the EV, the enterprise value, is important as a valuation parameter because it includes the total value of the company, including all the debt, including investments. And because of that, it facilitates comparisons between companies with different capital structures, companies with different tax rates. So if you're looking at two companies, one has got cash in the balance sheet and the other's got a lot of debt. The one with a lot of debt, if you just use a price earnings ratio, it's going to look very cheap because interest is so low. but you might be paying a much higher value for the business than you realize. And I saw this particularly, I was talking about Carnival and other cruise stocks in the first quarter of the year, because I couldn't understand. The share price had halved, but they'd issued a lot of equity and they'd issued a lot of debt. And as a consequence of that, Carnival, if you looked at the enterprise value, the total value of the business was higher than it was pre-COVID. Of course, the share price looked cheap because it was 50% of where it came from. But the total value of the business had actually gone up, which is, I mean, obviously, you wouldn't expect Carnival to have gone up when it's got all this much higher level of debt and all the uncertainty about whether the vaccine is going to work, whether people would want to go back cruising. And this distinction is super important, and using enterprise value is super helpful. EV parameter in these in all sorts of multiples. And if you are able to access a Bloomberg or a FactSet or Sentio, which is a system that I use and is shown here, all of them are slightly unreliable because the enterprise value, A, is static, and B, doesn't include some of the refinements that I'm going to talk about. So in this particular example, which is Diageo, there's about 20 billion of value in minorities, in associates, and in free cash flow, because you can see here there's a free cash flow of 5% and 5.4%, which means that the enterprise value, which is shown as static as 133 billion here and here, by the end of 2022, that valuation will have fallen quite significantly because the company is going to generate 5 or 6 billion of cash. So 133 only be 127, which makes a difference to the valuation. And this idea of a rolling enterprise value is one of the key elements that people generally don't understand. So let me just run through this a couple, I'm not going to go into all the detail because there's probably an hour and a half of explanation of all this in the course, but let me just show you a couple of snapshots. At the time, Diageo's share price was £30 and its market cap was 73 billion. And that was the equity value. If you wanted to calculate the enterprise value, you would add on the net debt, which was 9.1 billion. So that would give you what I call the basic enterprise value, which is the market cap plus the debt plus any preference stock. And that 82 billion is a reasonable, crude guide to what Diageo is roughly valued at as a business. But it's not that precise. That's the number that you'll see in Bloomberg, but it's worthwhile spending a bit more time and doing this in a bit more detail and looking at minorities and associates. And if you look at the Diageo profit and loss account, you'll see in here that the share of after-tax results of associates is 300 million, and non-controlling interests, that's the minorities, it's 122 million. And you've got to value those. And how do you do that? Well, the simplest way of doing that is just simply to value them at the Diageo price earnings multiple, which is quite easy to do. And you can do it, I've done the calculation here, which means that the enterprise value shrinks by about 5 billion because the associates are worth more than the minorities, the associates being investments that you own, minorities being a liability to third parties. The better way of doing this is to value the minorities and associates separately. But if you're going to do that, you need to know what are they and what they're worth. Sometimes, often, these investments or these minorities are quoted, and you need to go through the list of subsidiaries in the accounts in order to identify what they are. And you can see in the case of Diageo, its principal associate is a 34% interest in Moët Hennessy, which is majority owned by Louis Vuitton LVMH. And Diageo is quite helpful in its accounts because it explains this interest and it gives you quite a lot of detail around it. It also gives you balance sheet data. And this 34% interest is the main item in associates. And, you know, I could have gone off and valued this very precisely, but for a shortcut, all I did was I said, look, Diageo is on 25 times. Moët Hennessy is a better business. Let's put it on 30 times. You don't have to be super scientific about all of this. if I was doing this as a professional analyst in a hedge fund, I would spend a lot of time trying to get that answer. But obviously, I'd have access to sell-side research, and it'd be relatively simpler. Just doing it as a private investor, however, you can take shortcuts. You need to take shortcuts. And there's a further 7 million of associates, which I would just value at the Diageo PE, because I don't know what they are. And it's not worth my while finding out, because it's only a couple of 100 million. And that takes me to a value for the associates of 9.3. Now, if I had loss-making associates or loss-making minorities, what I would then do is I would use a multiple of book. And I might also do that if there's limited information about the investees. And it's exactly the same thing with the minorities. Here we've got the minorities in the balance sheet are 1.8 billion. And if it was loss-making, that's the kind of number I would use. I might use a multiple of that. In the case of Diageo, the minorities include United Spirits in India. And that minority I can look up and I can value it at the current market price, which happens to be 1.8 billion. There are other minorities. Sometimes the detail isn't disclosed, and you just need to understand how much of the minorities is the one USL and how much are the others. And again, apply the Diageo multiple. You can see here, I've gone through in the course, I've gone through the detail of this, exactly how you do it. And because USL has got a different year end from Diageo, you've got to start to look at the quarterly numbers. So it becomes more complicated. But I'll show you how to do all that. It's not difficult. It's not intellectually challenging. It's just fiddly. You just need to know how to do it. There's a formula for doing it. And, I go through in the course, I go through then, how do you look at debt at market value? How do you look at stock options? How do you roll forward the EV? How do you look at operational liabilities? And there's a whole series of other complications and other refinements I go through, which obviously I don't have time to go through today. So let me just turn now to stock market multiples and tell you a little bit about that. I'm just trying to give you a flavor of what we cover. And I showed you this chart earlier of the different multiples that we talk about. And the PE is the most common tool, widely used and understood. The main thing about the PE is that the definition of EPS is the main issue. And I look at this that, yes, this is a course about valuation, but you do need to understand a little bit about accounting because you're using financial data. You need to understand what you're looking at. And I do a little bit of explaining in this course, but obviously I have other courses that explain in far more detail about how to read a balance sheet, how to understand when the company's massaging its numbers, making its earnings look better. And you see a lot of this, particularly in the United States, where companies will define adjusted earnings and they're kind of like, it's earnings without all the bad stuff. And you need to understand what you're looking at. But once you've decided what the real earnings are, what I tend to do is I look at the price earnings ratio on a historical basis in the current year and next year. So I look at it 2 years out and I look at the progression of that PE. And I particularly like to look at the PE relative to the local market. So I look at what was it trading at relative to the local market historically, and what is it going to be trading at in 2 years' time? Because if I'm paying a premium, if I'm paying 140% of the stock market average multiple historic, I want that to shrink. I want to know the company's growing more quickly than the market, because if it's growing more slowly than the market, it's unlikely that that premium will be warranted. Sometimes a company will attract a premium because it's very consistent. It's a very consistent deliverer, even if it's not growing that fast. Ideally, of course, what we want to find is a company that's very consistent and growing more quickly, so that in 2 years' time, it will be trading at a lower multiple and it will get re-rated again. So it might go 140, 130, 120. And what we're thinking about, well, if it gets back to 140 in 2 years' time, I'm going to make 15% on the rating. And that's the opportunity. That's where you're going to make your money. And I talk a little bit about how you can break down the PE ratio. And I go through, how do the fundamentals impact the PE? And this chart is very important because what this chart shows you is I've got the growth in earnings along the x-axis. And I've got the PE along up the y-axis. And you can see that as the growth increases, the multiple expands. And it's not quite an exponential expansion, but you can see you pay a hell of a lot more for a fast-growing company than you do for a slow-growing company. And it's important to understand that relationship. And it's also important to understand that this forward PE has been a very good, long-term, consistent predictor of how much money you're going to make. Now, obviously, we're at a 5,000-year low in interest rates, so the forward PE is bound to be higher than it has been in the past. And that doesn't necessarily mean that you're not going to make money. But the forward PE has been a very good predictor of the long-term returns. You can see here the 1-year returns, the scatter plot doesn't look very consistent. But if you look at the 10-year returns, the cheaper the starting PE, the more money you've made. And once you get up above 25 times earnings, usually you've ended up losing money subsequently. Not saying that you lose money now, but that's the risk, because if interest rates revert to prior levels, then it's unlikely that the valuations, particularly of some of these racier companies, will be sustained. So the conclusions on the PE ratio: there are no magic bullets in valuation. The PE is the simplest and easiest tool. It encapsulates a lot very quickly. It's recognizable, it's intuitive, and that progression of the PE over time is very informative. But the weakness is it's affected by high leverage, particularly today. It's affected by low tax rates. So if a company has got a low tax rate, it will look cheap, but it may not be, especially if that tax rate is going to revert to a more consistent, more normal level. And remember that adjusted earnings per share are not always reliable because they're made up by management. And of course, the PE ignores returns, and returns are one of the most important criteria in assessing what a company is worth. And we go into all that in the course. Other valuation techniques, I go through lots of valuation techniques, DCF, sum of the parts, and I'll just touch comp analysis, comp transactions. And I'll just touch on a couple of these things just to give you a flavor. So if you want to do a DCF, how do you do it? Well, the first thing you need to do is you need to forecast the cash flows from the business for the next 10 years, including the capital spend. That, as I said, is extraordinarily difficult. You then need to use a discount rate. So you need to work out the discount rate. And the discount rate commonly used is the weighted average cost of capital, notwithstanding what I said about the capital asset pricing model. And I show you how to do that calculation. You then need to estimate the value of the business at the end of the forecast period. The problem with this is it's highly subjective, but I also show you how to do that. And then you need to discount those cash flows and the terminal value back to today, because you've got cash flows in the future. You need to bring them back to today using that discount rate. You need to then adjust for any investments or non-core activities or potential liabilities. And then you need to do the final check. This is the 1.6 is what people often forget, because they get the answer and they assume that's the right answer. That's not the case. You need to do a lot of check to make sure that you haven't made any mistakes. It's very easy, very, very easy to make mistakes when you're doing valuation. Some of the parts, similar kind of process. You work out what's a divisional analysis. You get the segments from the company. You then decide, should you value the debt within the divisions or at the group level? Sometimes if you've got a financial business, you want to put the debt in at the divisional level. I generally put the debt in at the group level. Similarly, you also might need to decide how to allocate tax divisionally or group. If there's funny sort of business in there, you might want to do it at the divisional level. Usually I would do it at the group level. You then calculate the values of each business and add them up. You value the group HQ costs. I take the total value of the business. I take the total earnings. I then get a multiple and I apply that to any central costs. You deduct any central assets or any central liabilities or add in any assets. And then you derive the valuation and assess the appropriate discount. And I show you a few examples of this. This is just one of the examples. This is a real life example from my life as in a hedge fund, because we looked at Whitbread, and you can see that what I did was I calculated what's Whitbread, how much money was it making out of its restaurants, how much money was it making out of its hotels. I separated the hotels into the property asset and into the operating business. I valued the leases from the propco to the opco. I then took Costa Coffee. I valued that. Costa Coffee subsequently sold to Coca-Cola. And then I deducted the central services at an average valuation, took off the net debt, including the pensions, to get a value for the equity. I then divided that by the number of shares to get the value per share, took the share price and said, oh, it's trading at 26% discount. That, as it so happens, wasn't sufficient margin of safety for us to invest in the business. I was kind of slow, because if I'd been cleverer and smarter, I could have bought it at 31 pounds. But I kind of was slow, and by the time I'd done the work, share prices started to move. Subsequently, the stock did very well, and maybe I should have bought it. And we go through comps. This is the Sentio printout of the comps for P&G. And you can see that there's a whole range of different companies. And what Sentio does for you automatically is it looks at the historic PE, the next PE, the current year PE, and it calculates the mean, median, maximum, and you can relate the Procter & Gamble's on 22.8 times falling to 22.1. So it's not growing. And you can see the average here is 24 times falling to 22.5. So it's at a discount, but the discount's shrinking because it's not growing as fast. And we go through how you can think about all this in the course. And then we go through a whole bunch of other evaluation techniques. This is the longest part of the course, and we go through some really important things like how do you value quality, compounders, all sorts of refinements to valuation, all sorts of tricks on some of the parts and other tricks. And this idea of what to pay for quality is a really important concept. And people are not as willing as they should be to pay up for good businesses. And this is looking back to the Nifty 50 in the 70s. And if you had bought Philip Morris at 24 times, you might have thought that's quite a high multiple in 1972. But in actual fact, you could have paid 68.5 times and still matched the S&P. So the stock market had not valued the consistency of Philip Morris's earnings nearly highly enough. In contrast, look at Schlumberger, another high quality business. And remember, this is 1972. This is before the 1973 and 1979 oil price shocks. Oil quadrupled. The opportunity for Schlumberger was huge because the oil services stocks are highly geared to the oil price. Because as soon as the oil price goes up, oil companies do much, much more exploration. So they're tremendous gearing. But look at that. Schlumberger was on 45.6 times, and you should only have paid 28.6 times for it. So it was hugely overvalued. So you need to understand both the valuation and the consistency and the quality of the business in terms of its earnings production. So just to conclude, valuation theory is an academic subject. It's very dangerous to value a company without using at least one EV-based measure and using a equity-based valuation metric. EV, pretty complex. Even the professionals often get it wrong, and the systems don't give you the right answer. Valuation, you cannot ignore the accounting and the presentation of the financials. So take one thing away from today, use more than one valuation metric, use at least two, and think in value ranges. So that's it. The valuation course is normally $599, and we're going to give you a big discount via Teachable. I'll hand back to Jonah, and we'll do some Q&A, hopefully. Jonah.
Yeah, thank you so much, Steve. I appreciate right off the bat, we were talking right before the event, how little financial education there is in general, and just schools and all of that. And you hear we're constantly accosted on YouTube and all of these platforms of various people saying, this is how you got to do it. This is how you got to do it. But they very often don't give you a lot of information. So right off the bat, I appreciate you sharing this time and and giving us a little more of an in-depth look in valuation in general, which is something I've heard about but haven't actually gotten an in-depth education about. So I appreciate your time very much. And for everyone watching, feel free to pop in the comments and ask any questions you want. I did want to ask a couple questions, and first, just about your course in general. Uh, for those who are just starting out in their kind of financial education, learning more about stocks and trading and all of that, are there any prerequisites or kind of bits of information, like various words and just the language of finance, that you should know before diving into the course? Or is it a
Well,
beginner can hop right in and feel
I
good
mean,
there?
I'll tell you, Jonah, this course is helpful for beginners, but it's targeted at people who've got some understanding. I mean, I wouldn't, if you're a complete novice, don't start with this, because it's, it's quite detailed, it's quite comprehensive, and you'd be much better off spend some time on my YouTube channel. I've got loads of free training materials on the website. I've got a blog. Spend some time. Don't go straight into this, because I don't think you definitely would learn a lot, but I think it's too big an investment.
Right.
Start slowly, learn the basics. And I don't really do too much on, I mean, the course obviously explains what a PE is, so you can learn that, but honestly, you can go to all sorts of sources, and they're free. And my YouTube channel is quite helpful. And if you, as I say, if you sign up on the website, I've got a whole load of free training materials in my club site, which is behind. It's not a paywall because it's free, but you need to sign up in order to get access to it.
Awesome. And for everyone watching too, I did pop both Steve's YouTube and his website URLs right in the comments there. So they're easy. You can click on it, go check out those resources. And I wanted to start off the Q&A with just a couple questions that I had brewing while we were talking here. You mentioned like the cycles of companies and looking for companies with cycles, but how in the last couple decades, it's been difficult to find overall cycles in our economy because of all of these things. Are there certain, without getting into the realm of financial advice, because that's not what we're doing here, but just as your opinion is, are there certain, out of fascination, certain like sectors or certain companies that tend to have more cycles independent of the greater economic changes?
Yeah, thanks for the question, John. It's a very good question. And yeah, I mean, we haven't, as I was trying to explain, we haven't had an overall economic cycle as such. We've had downturn in the early 2000s, which wasn't, I mean, it was a bad period for the stock market, but really only a bad period for the very highly valued tech stocks with difficult economy. And then we had, very strong growth through the mid 2000s till 2008, when obviously with the global financial crisis. And then we've had a very strong, fairly consistent economy in the 2010s until we had COVID, another massive drop. But in that 20-year period, although we've not really had the normal ups and downs, individual stocks, individual sectors have had. And a very good example of that is the transport sector, because the transport sector has its own cycle, because the transport sector is incredibly sensitive to small movements in demand and changes in supply. So I mentioned the cruise industry had massive amounts of capacity coming through. And I mean, they've done very well to generate lots of demand to fill the ships. But this is a classic sort of illustration of a sectoral cycle. Other one's oil. Oil's been through, it was up at $150 in 2008, and it's been down to, what was it, 40 in last year. It got lower than that. Well, it got negative at one point.
Right.
So within each sector, there often is an earning cycle, even though the overall economy is growing quite nicely. And so you've just got to adapt your strategy to that that sector. But that's why I think the enterprise value to sales is such a useful tool, because it takes the cycle out of it. Because what happens if you've got a cycle, at the top of the cycle everything looks really cheap, and at the bottom of the cycle everything looks really expensive. So you're induced to buy at the top and sell at the bottom. So the EV to sales is a good discipline, because it stops you getting sucked in or sucked out at the wrong point.
Right. Well, so if you're someone who's, you know, a little bit about this, you know, the terminology and stuff, but you still haven't like acted on the knowledge you're accruing. So you're starting to do valuation and stuff, but you're still, you know, you got cold feet about actually buying stocks or maybe making big moves in it. Do you have a recommendation? Are there websites you can use to kind of test your stock knowledge without buying it? Or do you like, what's a good point to actually start making those investments?
The time to start making those investments is now, because no, I'm not being facetious. So we were talking before we came on about how, you know, schools are very bad at equipping people with financial knowledge. And I was mentioning that the charity, the Financial Times, has launched this charity, Financial Literacy and Inclusion Campaign. And what they're trying to do is to improve people's understanding of finance. And they're doing that through both encouraging the government to teach people in schools, starting in the UK, and also encouraging providers of financial products to be a bit clearer about what they're selling. Because, you know, the trouble with finance is everybody involved in finance has got a vested interest in making it sound really difficult so they can take your money.
Right.
And look, I'm not pretending that it's simple, but it's not a fraction as difficult as people make it out. And, you know, I mean, you know, obviously I'd love everybody to buy my book, and you can buy it for like $2.99 on November the 24th. And you read my book, and it's a very accessible, easy introduction to how to make money in stocks. But when I say the best time to start is now, I really mean that, because the most potent force in investing is compound interest, right?
So time, right?
You know, the stock market tends to go up over time. So the earlier you're in it, the longer you're in it, the more amount of money you're going to make. Now, I'm not saying that because I think the stock market is going to go up tomorrow or next week or next month, but if you start saving a bit and putting it in the stock market, over time, that compounding will alleviate the financial pressures that you'll have when you retire.
Right.
So start now. And how do you learn? You learn by losing money.
Right.
But look, you know, investing is a very curious pursuit, because there are very few endeavors in which you can be right 2 times out of 3. So you can 1/3 of your decisions are wrong, and you can be the most successful investor in the world. I mean, George Soros has got an exceptionally low hit rate, but when he's right, he bets big. So he loses a lot of the time, but he loses small amounts of money. And the thing about losing money is it teaches you a lesson. And you can't, you know, doing my courses will certainly make you a better investor, but you only become a good investor once you've suffered a lot of pain. And this is a psychological game as well as an intellectual game. And you need to lose the money, learn how it feels, understand where your strengths and weaknesses lie in order to be successful. And every successful investor will tell you this. I mean, if you sit down with them and they'll and speak to them, have a really serious discussion with them, have a proper dialogue with them, they'll tell you losing money has taught them how to make money. So the best time to start is lose money at the beginning, because you're going to be deploying less capital, so you lose less. But you can't be successful unless you've made mistakes. And it's not and it's not possible to get 9 out of 10 in investing. It's just not. You know, the best investors make mistakes because it's every day things change. There's too many things going on in the world. There's too many aspects, too many facets of investment, too many things to cover. So you always make mistakes. And what you need to do is you need to learn to accept those mistakes, learn from them, not beat yourself up, not lose sleep overnight. And that takes us, there's a certain amount of intellectual understanding, there's a certain amount of learning involved, but there's also a big element is psychological. And I know some people who you would say these people, they really aren't very smart. They're really successful investors because they know they're not smart. They understand their own weaknesses, and they're very good at understanding, oh yeah, I understand this business, and I can understand that it's going to make me money. And they then have the psychological fortitude to invest and sit back and let the money grow.
Right. They're not making those mistakes down the road when the opportunity is really there. Right.
Yeah.
Yeah. I appreciate that attitude so much. We're going to wrap up just for time. I appreciate your time so much, Steve. For everyone watching or either the live event or the replay, the link to Steve's course is in the comments. It's also in the description, and it will be emailed to you along with the replay. And feel free to pop any comments in there anytime. We do come back and love to see what you all are talking about. Thank you all so much for being here. And before we wrap up, Steve, I'd just like to ask for those people, kind of a wrap-up question for those people who are starting on their financial journey. They've learned a bit, but they're still a little cold feet or worried to get in the game and make those mistakes and lose money. What little advice do you have for them just to keep going?
Well, I mean, the beauty today is that you can trade for free. When I was starting, it was very expensive. So, just the frictional costs of buying this one share, buying one piece of stock was huge. But today it's not. So, just take $100 or $1,000 of what you can afford to lose and start buying some stocks that you think are interesting, and, or do it virtually, do it, on a piece of paper or on an Excel spreadsheet, and just say, okay, I'm going to have a fictional portfolio of $1 million, and I'm going to buy 15 stocks. I'm going to buy Amazon and Facebook, and then watch and think about, okay, so it's gone up today, it's gone down today, it's gone up this week, it's gone down this week, it's gone up this month. However, I mean, I wouldn't advise looking at it too frequently.
Right.
The best thing you can do is look at it regularly, but not all the time, because if you look at it too often, you'll get emotionally pulled by the ups and downs.
Right.
And just, the best thing is do it with real money, but don't bet a lot, because if you do it with real money, the lessons are much more powerful. If you're just playing with a paper portfolio, so I lost 10%, it doesn't hurt. You need to feel the hurt, right? So I would say do it with some real money, but some money that's not going to worry you. You're not going to lose sleep over it, but you'll feel some pain.
Right. I appreciate that so much. Well, thank you again, Steve, for sharing your time with us and your knowledge. And for everyone watching, if you like this video, please like and subscribe to the Discover YouTube channel. We're trying to bring more creators and intellectuals like Steve out to share their knowledge and help us all grow in all these many facets of having a healthy and beautiful and financially fruitful life. Steve, have a wonderful day. We appreciate you so much, and we'll see you soon.
Thank you. Thanks, Jonah. Thanks for having me.
Cheers.